recording. Now let's do the share screen. Well, I don't see my, there it is. All right. Okay. Just a little review. We talked the first week about who qualifies as a minister under the Internal Revenue Code. There were 3 criteria. You had to be either ordained or commissioned or licensed. And yet we saw that for those, particularly those of us in the church that do not have the ordaining or licensing or commissioning body, that the courts have ruled that those who do not have such a body are qualified once they start doing the work as a minister. We also in that process talked about sacerdotal functions, those functions that a minister performs. The next week we talked about is the minister self-employed or an employee. Then last week, well, the last time we met, which was actually 2 weeks ago, we talked about issues around electing out of Social Security or Medicare. At that point in time, I assigned you a essay paper that will be due on the 8th of March, along with our final exam. And that essay paper is to write as best you can, give me some arguments on one side or the other about electing out of Social Security. A lot of people that may not qualify, but may not apply to, because they are no longer have the option. I think, Brian, that you probably still have the option because you've been preaching for less than 2 years. Is that correct?
Yes, sir.
Okay. So you would have the option to elect out of Social Security because that timeline begins in the first year in which you have at least $400 of self-employment income, some portion of which came from ministerial services, and it ends in the due date of the tax return for the second year in which you have that $400 or more of self-employment income, some portion of which is from ministerial services. So if last year was your first year to be a minister, you do have that option to elect out, and you can do it on the first or second tax return that you file that has ministerial services income on it, at least $400 or more. So that, and just as I said, you have all of you have an essay paper due on March the 8th about arguments for or against electing out of Social Security. As I said, I can argue both sides of that. Doesn't matter to me what your choice is. I can understand and argue either side of it. So tonight, we're going to talk about what is income for a minister. And we're going to talk about, as you should be able to see on the screen, a variety of things. Obviously, your salary would be income. Retirement gifts. We'll have some special discussion about retirement gifts. Special occasion gifts we'll also have some additional discussion about. If the church decided to sell you property for less than the fair market value, so you started working for a church and they owned a parsonage, they owned a minister's house, and you worked there 5, 6, 10 years, and they said, why don't we just sell you this house? And yeah, it's worth $150,000, but we'll sell it to you for $100,000. that difference in what they sell it to you for and the fair market value would be income to you. So if you purchased, if the church owned a car that they were allowing you to use and they sold it to you for less than fair market value, the difference in what you paid for it and fair market value should be income to you, should be reported on your income tax return. If the church reimburses you for business expenses other than under an accountable plan, and we'll talk about accountable plans January 25th and February the 1st classes. We'll be talking about some of those accountable plans, what makes one, what do you have to do to have one, etc. But if they reimbursed you other than under an accountable plan, then those reimbursements would be income to you. Let me clean up my screen here a little bit so I can get less confusion on the. Okay, now why did that go wonkers? There, okay. Any reimbursements that they made that were not reimbursed under an accountable plan would be income to you. Any bonuses they pay you will be income to you. If you are subject to Social Security and the church pays their share, they don't have to. It's a decision that, for example, we made for our minister who did not elect out of Social Security. We elected to pay the employer share of Social Security to him. That is income to him. He has to report it on his income tax return. If the church owns a vehicle and you use that vehicle personally, personal use of that vehicle would be subject to income tax. You need to report it. If the church loaned you money, and I'm getting a horrible feedback from somewhere, I don't know what. Maybe on my side, maybe on somebody else's side, I don't know. If the church loaned you money and forgave the debt, that forgiven debt would be income to you. If the church paid for your spouse to travel for an event where she was not active in what you were having to do, then that travel expense would be income, or travel monies would be income to you. Let's talk about that issue for a few minutes. Obviously, if you go somewhere in your personal vehicle and the church reimburses your mileage because you're doing business stuff, your spouse going with you or your family going with you does not require you any additional expense. So that wouldn't be a situation that we're talking about here. But if you, for example, went to polishing the pulpit and flew to Knoxville or to wherever, some close airport, and your spouse went with you, their airline ticket, unless she is doing something there, to benefit the church, then she is not, whatever they're paid for her travel would be income to you. If you went to a gospel meeting, 4 or 5 states away and you flew to go there, if you're holding the gospel meeting, your wife is just going along, that travel cost would be income to you. Health insurance premiums, I put a question mark beside that. Some of those things, health insurance premiums, depending on whether you get a W-2 or whether you get a 1099. If you get a W-2, the health insurance premiums generally will not be income to you. If you get a 1099, the church should include in your 1099 all the health insurance premiums they paid on your behalf. If the church made to you a below market rate loan, then the difference between the interest they should have charged you at market rate and what they actually charged would be income to you. We will discuss some tax-free fringe benefits later on, and along with some group term life insurance issues, scholarships, employer-paid health insurance premiums, tuition reductions, lodging for the employer's benefit, educational assistance, employer-provided child care, etc. All those things we will discuss in the next couple of sessions, or the January 25th, February 1st sessions. We will have discussion about other things that you may have questions about, whether or not they are income. We will right now talk some of this gift issue. And it's your chagrin or your loss that we're not doing this in person, because the way I generally do this is I take a $50 bill out of my hand and I give you a scenario. And let's talk about that scenario. Brian, Justin, y'all both in the pulpit. So say you finish your lesson on Sunday morning. You go to the back of the auditorium and you're standing at the back shaking hands as everybody comes out. And, you know, the person walks up to you, and as they shake your hand, you realize there's something they have put in your hand. Well, you're busy talking to other people, so you just slip it into your pocket, and once you finish shaking everybody out, you reach down in your pocket and you pull out what they gave you, and lo and behold, you have a brand new crisp $50 bill sitting in your hand. Is that income or not?
I don't know. I'd never thought about half of the things that we just talked about being income, so I really don't know.
The courts have ruled that a gift is dependent on, by definition of whether it's a gift or whether it's income to you, is dependent upon the intent of the donor. And in a 1956 circuit court ruling, they made the statement, a gift in the statutory sense, on the other hand, proceeds from a detached and disinterested generosity. Commissioner versus Lobu. Robertson versus United States, out of affection or respect or admiration or charity or like impulses. In this regard, the most critical consideration, as the court said, was the transferor's intention. I don't know why this thing keeps there. So Duberstein, for example, what controls is the intention with which payment, however voluntary, has been made. So in the scenario we just talked about, if you're standing at the back of the auditorium shaking hands and somebody slips a $50 bill in your hand, what's their intent?
I'd say a gift.
I'd say it's a gift, but let's complicate the situation. If you've been there for 10 years, 5 years, some period of time, and as the person is shaking your hand, he makes it known that he's putting something in your hand, and he says, you know, preacher, they just don't pay you enough, so I'm going to help you out. What's the intent now?
I would still consider that for charity.
Would it matter if it's a one-time action or multiple time?
Not really. I don't think it would really matter. But he has expressed a view that they don't pay you enough, and I'm going to fix part of that. In that case, if the IRS were to subpoena him, for example, it might be argued that whatever he did was income to you. Because what was intent? What was the intent of the donor? the intent of the donor in that second scenario was you need more income. You need more salary. We don't pay you enough salary. So in that situation, the argument could be made that the intent was that you have more income. So the gist of the issue is, what's the intent of the donor? Obviously, we can't read somebody else's mind. We have to depend upon what they say. And if there's limited conversation that goes along with it, then my argument would be it's not income to you. But if there is conversation that goes along with it, even if it's a one-time event, and they say, I just don't think we pay you enough and I'm going to make it right, then we may, the IRS may very well have an argument that you've got additional income. Now, as a general rule, if that ever happened to you, I suspect you might faint, but beyond that, I would just take it as, a gift. And especially if it were along the lines of, here, preacher, go do something, buy your kids something nice, or take your wife out to a nice meal or something like that. You and your wife go have a date night, those sorts of things. My argument would be the intent is they just have detached, disinterested generosity out of affection, respect, admiration, charity, or like impulses. They just want to give you something that you can enjoy and your family can enjoy, and it is, in that case, not income to you. So we do have a couple of court cases. Banks versus Commissioner, a 1991 court case. The church in that case had various occasions throughout the year in which they would have special offerings, and they termed them as gift offerings for the minister. They were paying the minister approximately $30,000 to $40,000 a year, and they were making up another $40,000 or so in gift offerings. And in that particular case, the court held that that was income to him. Similar situation in the Godwin 1995 case, where the church would have special occasion gifts. And in this case, they had a lot of structure behind it. It was well publicized to the membership. Every member was encouraged, in fact, almost given a certain dollar amount they were expected to gift, etc. So all the things like that the court looked at, where they took up a special contribution, did a lot of planning for that, did a lot of publicity around it, and the intent in the court's view was to give the minister additional income. And in that case, the Godwin case, over 90% of his income came from these special occasion gifts. So if it's something where, the church just says, okay, out of, we're going to celebrate a 5-year anniversary and we'll put up a money tree, and whoever wants to will put money on the tree, and at the end of this celebration meal that we're having, we'll just, the money tree is yours. I could argue there that that's a gift. It's recognizing a special event, and we'll talk a little later on some of those issues that will lend a little more clarity there. But in both of the two court cases we cite here, the 1991 and the 1995 case, more than half or at least half of the minister's income was coming from these gifts, and the church just knew that that's the way they were going to pay him, was through these special gifts. So nothing really major there, nothing really unusual there. as far as the court is concerned. They looked at it and said, no, you're giving him additional income, additional salary, and choosing to do it via gift as opposed to do it via salary. We do have some court cases that are fairly old court cases. The first one you see referenced there, a 1949 case. 3 more cases in 1954 where the church was giving retirement gifts to ministers, including recurring monthly payments, and the courts in those 4 instances held that these retirement gifts were not income, but were truly retirement payments. The ministers in this case didn't have a retirement, and we'll talk retirement issues February the 22nd, but they didn't have a good retirement, especially, I mean, if you think about the economic status of ministers back in the late 40s and early 50s, mid 50s. Most of them lived in church-owned housing. Most of them didn't, as they went through their career, didn't amass any wealth. They didn't have a house to earn or to live in. Once they retired and no longer were able to live in the church's housing, they didn't have anywhere else to live. So the courts in these cases looked at those situations and said, out of the fact that these people worked for you as ministers for some period of time and are now retired and didn't earn any equity in a home while they were working, we will allow these gifts that you're giving them to be treated as non-taxable retirement income to them. Part of it may even be under the housing allowance type thing, and we'll talk as we talk housing allowance, how some of those housing allowance payments can possibly be, retirement payments can possibly be treated as housing allowance. So there are cases out there, but as I say, they're fairly old, over 50 years old, over 60 years old, where the courts held that there were some retirement gifts to ministers that could be tax exempt. So I don't think either of y'all are close to retiring yet, but as you get along in life, you may start thinking about some of those issues. But, the other thing I would encourage along those lines is, if at all possible, do a housing allowance and buy your own house as opposed to living in the church's house, because that can enable you to build some equity and wealth through that process. And when you retire, then you may even have a place to live as opposed to not having anything available. Section 102C of the Internal Revenue Code says that any amount transferred by or for an employer to or for the benefit of an employee cannot be a gift, with 2 exceptions: employee achievement awards or de minimis fringe benefits. Employee achievement awards, let's just look at that. For an employee achievement award to be tax exempt, it must meet the following criteria. It cannot be cash or cash equivalent. It cannot exceed $1,600 in value. It can only be awarded every 5 years. And it must be for a length of service or safety achievement. So we talked earlier, say, as a scenario where you've finished 5 years with a particular congregation, they want to have a recognition meal and say wonderful things about you during that time, and they put up a money tree. Would that money tree be, the funds in that money tree be tax exempt? And there's a couple of issues here we need to think about. Is it the employer that's giving you what's on the money tree, or is it the individual members of the congregation? In that case, I would argue it's individual members of the congregation that are giving you what's on that money tree, so it would not be an employee achievement award. So let's take a different scenario. You finished 3 years with a congregation and they say, we appreciate what you've done. In recognition of 3 years of service, we're going to buy you a set of Gospel Advocate commentaries or Truth for Today commentaries or something like that. And it's going to cost them, say, $1,200. Can they do that and it be tax free to you, tax exempt to you? Yes, because it's not cash or cash equivalent. They're not giving you money. They're not giving you gift cards. They're not giving you gift certificates. Now, if they gave you a gift certificate to the Gospel Advocate bookstore or the local Bible bookstore, you run into a problem there because that's cash equivalent. But if they bought you a set of commentaries, that's not cash or cash equivalent. It doesn't exceed $1,600 in value. They haven't done it within the last 5 years for you, and it's based on a length of service or a safety achievement. They said, because you've been with us 3 years, we want to do this based on length of service. So in that case, they could do something like that, and it would not be, that's deemed to be an employee achievement award, and it's not taxable income to you. I worked, for example, for 17 years with Bell South, and this watch I have right here is engraved on the back, Bell South, and I got it as an employee achievement award. Every 5 years we would get a catalog, and at 5 years and 10 years and 15 years you got to select a gift from the catalog. And guess what? The maximum value of any item in that catalog was less than $1,600. So because it was based on length of service, because it was only done every 5 years, because the value was less than $1,600, because we did not get cash or cash equivalent, the monies or the product that we got was non-taxable to us based on the Employee Achievement Award laws. All right, let's go back and talk just briefly, and we'll talk some more about de minimis fringe benefits. De minimis fringe benefits is something, the way the Internal Revenue Code identifies it, it is something that you do for the benefit of your employees, and the hassle of keeping up with the cost and allocating the cost to the users or the beneficiaries of it is too big a hassle to fool with, in essence. So, for example, in the refrigerator in here, I have Sprites, and all my employees can walk in the refrigerator and pull a Sprite or a bottled water or whatever out of the refrigerator. And I don't try to keep up with who got how many and how many they drank and what they did. That's a de minimis fringe benefit. We have a copy machine in our workroom, and if an employee wants to go in and make a copy of a personal item on the copy machine, we don't track who makes how many copies and how many of them are for personal use. That's a de minimis fringe benefit. The Boston Bruins, I believe it was the Boston Bruins. I may get my fact a little skewed here. The Boston Bruins, a hockey team, plays half their games outside of their home arena. When they play outside of their home arena, they travel together as a team. They are put up together in a hotel as a team. The team hires a company that goes to each of the team hotels and caters for the team meals. They have certain meals that they have to eat, that they want their team members to eat at a certain time before the game because of the nutrition content of the meal. So they have done that in order to benefit their team members and to have some continuity of the experience that the team members experience prior to every game. The IRS sued them and said they could not deduct more than 50% of the cost of those team meals. They took it to tax court, and the tax court agreed with their argument that what they were doing was a de minimis fringe benefit. It was something that the employer was providing to the team or their employees on a non-discriminatory basis. In fact, for the team members, it was required that they participate in it. They all had to eat the same meal at the same time. The staff that was traveling with them, the administration of the team, were allowed to also eat. So it was a non-discriminatory basis. And the court agreed with them that this was a de minimis fringe benefit, even though they were spending $250,000 every time they did one of these things. For the company to come in and cater it, to buy the food, to prepare the food, to set up, to have the table set up, et cetera, it was costing them $250,000 or more to do that for every game they played. But the court agreed that that was a de minimis fringe benefit. Now, the interesting thing about this, that court case was decided early last year. Oh, actually, it was probably decided September or October of last year. And in the new income tax law that just got passed, the law now specifically excludes those types of things as de minimis fringe benefits. The new tax law does. So I gave you that example to give you an example of what the original or the tax code prior to the new tax law, how broad you could interpret de minimis fringe benefits. But the new tax law has specifically excluded those types of things. And I suspect, I don't know it for a certainty, but I suspect it was because of that court case that they added that language to the new tax law, which was passed and worked on in November, December, and passed in December. So if the court case ruling came out probably September or early October, Congress got upset. The IRS, I'm sure, got upset at losing that case and put that language in the new law to exclude that from de minimis fringe benefit treatment. So there are two ways in which an employer, i.e. the church, can give you something and it not be income to you. And the two ways would be if it's a de minimis fringe benefit or if it's an employee achievement award. So we've talked about those two ideas. Since the minister is considered an employee for income tax purposes, but is self-employed for Self-Employment Contribution Act purposes, assuming he's not elected exemption from Social Security on Form 4361, if the church pays the 7.65% employer's portion of FICA to the minister, it is considered taxable income. So anything they would pay, and I mentioned that on our first screen about these types of income of items would be income to you. So if they do pay their share of Social Security, and the minister that we pay it to, I have been told by them that they have never seen another church that has chosen to do that. So it's if I were a minister and had not elected out of Social Security, I would at least encourage them. You know, here's what you say my compensation package is. I've got to pay 15.3% of that for self-employment tax. Why don't you pony up your share? I mean, if the church has a secretary, she's not qualified as a minister. They're paying her share of Social Security. If they have other, janitorial staff or anything like that, they're paying their share of Social Security. Why not pay your share of Social Security as well? So if they choose to do that, though, that is income to you. So to some extent, them choosing to do that increases your income, and therefore you have to pay more self-employment tax. But it is worth it to get that if you can. Remember that the housing allowance is not taxed for income tax purposes. It is subject to Self-Employment Contributions Act if the minister does not elect exemption from Social Security. So in that case, when you're calculating self-employment income, and we'll look at some of the tax issues later on, example tax returns, the housing allowance gets added back for purposes of self-employment tax. We'll have a detailed discussion of the housing allowance next week's class, January the 11th, and that will be titled Maximizing the Benefit of the Housing Allowance. All right. One more issue to talk about, and that is assignment of income. A 1940 case, Horst had this idea: the power to dispose of income is the equivalent of ownership of it. The exercise of that power to procure the payment of income to another is the enjoyment and hence the realization of the income by him who exercises it. So let's take a couple of examples. A minister who holds a meeting but chooses not to take some salary or some payment as income because the congregation is struggling. The power to dispose of income is the equivalent of ownership of it. The exercise of that power to procure the payment of income to another is the enjoyment and hence the realization of income by him who exercises it. So if you go somewhere to hold a meeting, they say, we'd like to pay you $500, and here it is. You know, it's really tough for us. We're just having a tough time. The mill in town closed down, and most of our members are out of work, but we're going to pay you anyway. And you say, no, just take it. Just keep it. I'll just do the meeting for no cost to you. You have chosen to forego income. You have chosen to, in essence, assign the income back to them. My recommendation in that case would be to go ahead and take their $500, go home, cash their check, and turn around and write them a check for $500 and contribute back to them. If that's what you want to do, is give it back to them. You're going to have to report the income anyway, and that's a lot cleaner situation to say, here's the check where I contributed $500 to them, and here's my income, including their check for my $500 for holding their meeting. So that, as I said, is just a little cleaner area to do it. You know, if I'm teaching GSOP classes and they pay me a stipend to do that, and I say, no, I'll just forego that, got income. All right, one final, well, we'll have a couple of other little minor issues at the end, but unreasonable compensation. There is a legal concept called annulment, allowing the assets or earnings of the church to benefit an individual other than as compensation for services performed. If you read up on most nonprofit organizations, the contributions to the nonprofit, the assets of the nonprofit cannot inure to the benefit of an individual. So, for example, say you have a foundation that somebody sets up, or say you've got a church and all the members have died off and there's a building, some money in the bank. The church is a nonprofit organization under Internal Revenue rules and under IRS law. The assets that it owned cannot inure to the benefit of any individual. So if they said, Joe, we appreciate you being an elder at this congregation for the last 42 years. Here, why don't you just take title to the building? Doing that would be what is termed annulment. An asset of the tax-exempt entity is benefiting an individual. Now
what about the church helping individuals, you know, as far as if somebody needs their house payment paid 1 month or something like that?
If it is a benevolent situation, you're not in this annulment ruling.
Okay.
Now, if you did it every month, you might run into some issues. But if you're in a pure benevolent situation where you know it's just an occasional thing. I mean, we've got some members of our congregation where, you know, they need rent money occasionally, or they need a utilities paid occasionally, or they need this or that or something else. And we will provide them funds, or we will pay directly those sorts of things. And we call it benevolence. We're not, that's not inuring to their benefit, first and foremost, because they have no control. They can make a request. We've got a deacon that actually deals with those issues for us, and he makes the recommendation to us to do it or not do it. So they don't have any control over it first. They have no say over whether we do it or not, how much we do if we choose to do it, etc. They make a request, and we make a decision, yay or nay, to assist them. And, you know, from that standpoint, I would argue that it's not annulment, because it's not giving them, and from that standpoint, what we try to do, what we generally will do, is make checks payable directly to their mortgage company or their landlord or their utility company or whatever. And that, once again, goes along with the idea that it's a benevolence thing, and they're not we're not allowing the assets of the church to benefit them. We're using the assets of the church to assist them from a benevolent standpoint, but we're not allowing them control over those assets. So, yeah, I mean, that's a good question. But annulment, and generally annulment would be much larger dollars that you would want to be talking about rather than the occasional, mortgage payment or rent payment or utility bill payment or whatever. Annulment here is really more along the lines of some individual is using it as their own personal piggy bank or to fund their own lifestyle. So, you've heard of scenarios where some of these mega church preachers, basically are taking, and funding a very lavish lifestyle from the contributions made to the church. That's the risk of annulment.
Okay.
The IRS is going to come in and say, you're running a nonprofit organization, but you're benefiting yourself and your personal lifestyle by doing that. So there's another idea of unreasonable compensation. If you get paid more than what the IRS deems to be reasonable, then the church could be cited for unreasonable compensation. In the PTL bankruptcy case, the IRS and the bankruptcy court actually held that Jim Bakker should have received reasonable compensation between a range of $133,000 for 1984 and $177,000 for 1987. Actual compensation, including fringe benefits paid to him for those 4 years, was over $7.3 million. Now, the significance of it being the bankruptcy court, they're going to go back and try to recoup that difference between reasonable compensation and what he actually got paid and use that to pay the bills that PTL had, that they bankrupted. So that's part of the issue there with Jim Bakker. But, the courts held that there was a certain amount of reasonable compensation that he should have been earned, and he earned way above that. So the issue, if you ever run into a situation where the minister gets paid a percentage of the contributions, then you've got either potentially a unreasonable compensation issue or potentially an annulment issue. He's taking the assets of the church and using them to his personal benefit. So I would shy away from a situation where a church said, why don't we pay you X percent based on what the contribution is? Or why don't we base your income on what the contribution comes in at? We take a certain amount and anything above and beyond you get. Yeah, I wouldn't agree to something like that because there are potential issues legally and tax-wise with those types of situations. If the IRS found that the church had paid unreasonable compensation, and I believe the latest number is in excess of $215,000, then that would subject the minister to a 25% excise tax on the excess compensation. And if you don't pay that excise tax, could also be subject to a 200% tax under the intermediate sanctions rules. So in Jim Bakker's case, where we talked about he should have made $133,000 and he made, for example, $1.5 million, that extra $1.4 million or $1 million some odd would be subject to a 25% excise tax, and if he doesn't pay that fairly quickly, that excise tax should be subject to a 200% tax. So, yeah, that can, in essence, he's having to pay his taxes about 75% of the excess compensation that's going on. One other little item here. In 1986, the IRS audited Truth Tabernacle for 1983 through 1985. As a result of the audit, they revoked the church's exempt status due to unreasonable compensation paid to the minister. Only after a court suit was it reinstated. The church received annual contributions of less than $20,000, used all those funds to pay its mortgage, its utilities, and its repairs. The only compensation the minister received was free use of an apartment and a vehicle. But the IRS came in and sued or audited them and revoked their exempt status for unreasonable compensation. So there are issues, potential issues about compensation, about your income, about what is income and what is not, and how much the church can pay you, and are they paying you too much, unreasonable compensation. Like I said, I believe the latest number I've seen is $215,000 before you run into that risk of unreasonable compensation. I don't know any minister that's getting paid that. There may be some out there. If you know one of them, good for them. But the issue may be that, anything above that may be subject to annulment issues or unreasonable compensation arguments. One other issue, along with loss of tax-exempt status, Variety Club Tent Number 6 charities went to the tax court in 1997. They had one of their charity's officers embezzled money from the charity, and the tax court held that the embezzlement of the charity's funds, actually two officers colluded to embezzle the money, did not constitute annulment. So, embezzlement by an officer, or in the church situation by a treasurer, would not constitute annulment. However, the rental of a building from an officer would constitute annulment if the rental was not reasonable. So if you're going to own a building and rent it to the church, you need to make sure you get reasonable rent, because if you get too much rent, above reasonable rent, then the church could be deemed to be paying unreasonable rent, and whatever the excess is could be annulment, i.e., the assets of the church are going to benefit a member or an individual. Doesn't have to be a member, could just be an individual that's not a member of the church. So just a couple of court cases there that I find very interesting. So let's jump back up to the first slide again and just run back through those sorts of things. Obviously, your salary is income. Retirement gifts we talked about. It is possible, and we'll talk about in the housing allowance thing also, about possibly having some retirement gifts not be taxable to you, and having even some of them being coded as housing allowance, which would obviously not be income taxable to you. Special occasion gifts, we talked through that idea, that those things where, depending on how regularly and how much back office work goes into it, how much planning, how much of your compensation is compared to these special occasion gifts. Special occasion gifts may or may not be compensation to you. If the church should sell you something for less than fair market value, that difference between the purchase price and the fair market value would be income. Reimbursement's not paid under an accountable plan, and as I said, we'll talk about accountable plans later. Any bonuses the church pays you are income. If the church pays their share of Social Security or the employer share of Social Security tax, that's income to you. If you use a church-owned vehicle for your personal use, that's income to you. If the church gives you money, lends you money, and forgives that debt, that's income to you. If they provide for your spouse to travel with you and it's at an additional cost, then that additional cost could be income to you. Health insurance premiums, depending on how the health insurance policy is, and could potentially be income to you. Should not be if you're a W-2, but possibly, definitely would be if you're a 1099 person. And if they made any below market rate loans to you, then the below market rate, the difference between the below market rate interest and the regular interest they should have charged you would be income to you. So questions about income?
I have one.
Okay.
The reimbursement's not paid under an accountable plan. Now that would not include the church was going to buy something, and because it does not have like a credit card or a debit card, you purchase it out of your pocket, then the church reimburses you for what you purchase out of your pocket. For the church, it's books for a Bible class. That does not fall under that, right?
That's correct.
Okay.
But let's muddy the water a little bit. Let's say you go and buy a book for your library. And the church reimburses you for that. And let's say they have an accountable plan, so the reimbursement to you is not income to you. And you put the book in your library, in your office, at the church building. Who owns the book? When you get ready to leave 5 years from now, are you going to box that book up and take it with you? And if you do, is it a gift? Did the church gift you that book? Is it then income to you?
I'd say yes. To that example, I would say yes. That would probably be income.
Yeah.
And I'm just trying to get you to think. If the church, if you bought a book and you put it in your office, in the library that's in your office, and 5 years down the road you leave and you box it up, and at the time you bought it, the church reimbursed your purchase of it. My suspicion is the church is willing for you to box that up and take it with you. In which case, it's really been a gift to you. Now, when did that gift occur? Did the gift occur when you boxed it up and took it off with you? Or did the gift occur at the time they reimbursed you for it? My argument would be at the time you boxed it up and took it with you. The whole time it's there, anybody that chooses to could use it. You could let anybody in the congregation use it if they so desired, because in essence, the church bought it. So, that's just some things to think about as we, as we mull through some of these types of issues.
Yes.
Now, I wouldn't get too hung up on if I bought a book and the church reimbursed me, $75 for the cost of this book, and 5 years down the road, I boxed it up and took it off with me. Oh, I've got to recognize $75 worth of income. I mean, first off, the book's not worth $75 5 years down the road. Maybe worth more, maybe probably worth less. My argument may very well be, the church is gifting it to me at that point in time. But yeah, just things like that I wouldn't get too hung up on. But if the church, if you do not have an accountable plan for reimbursement, then it's potential that anything they reimburse you for is additional income to you. Whether it be travel expense or mileage or whatever, whatever may be going on. All of that could be income to you.
See, I'm not even sure what an accountable plan is.
We'll talk about that later. Yeah, I know. We'll talk about that later. And it's really, it's just a documented plan where the church agrees they're going to reimburse you, and the reimbursement is under the rules that the IRS sets forth for reimbursements to be done without it being taxable to you. So that's the gist of what makes it an accountable plan. They have the employee has to account to the employer for certain things about that reimbursement.
Does every congregation have one of those or no?
Well, the other issue is that it should be in writing. So probably very few congregations have it in writing. But an accountable plan should be in writing.
Okay.
All right. Other question?
Thank you.
All right. Next week, for right now, I just plan to go ahead and continue to meet at 7:30 Eastern. That helps you, Brian?
Yes, sir. That helps me a bunch.
Okay. You okay with it, Justin?
Yes, sir. That's no problem.
I figured on your on Central Time it was easier for you, or not really that bad for you. So, and I'll try to touch base with these other two and see if we can get them to join us. All right?
Yes, sir.
All right. Well, next week we'll talk about housing allowance, and the following week we'll have a review and a midterm. All right.
Yes, sir.
Have a good night.
Thank you. And I'll have the video out there a little later on tonight.
And are you going to continue to send the PowerPoints as well?
I will. I apologize for not having done it. I took a week off. I might have, I'm.
Yes, sir. No, I understand.
All right. I'll send that out to you when I send the link for the video.
Yes, sir.
All right. Bye.
Bye-bye.